because it all depends on the relationship. So I think how you classified it, it is a marriage. And sometimes it's more time commitment than a marriage if you are getting a business up and running.
Welcome to the Ownership Matters podcast, where we're going to talk about things that matter in your business, to ownership, to owning your perspective. So this week, most business partnerships don't just fail because of one big event. They fail because of small problems that go understood. So the host this week, we're going to have me, Bradley Scott. I'm a attorney, business broker, and commercial real estate broker. And then who else do we have?
We have myself, Aubree Denekamp. We handle all things finance, accounting, and all the things people hate with numbers. And we also have Danielle Byford.
Yeah, I am a business attorney focusing on general counsel, fractional legal counsel, and intellectual property matters.
Yeah, and I think the questions that we're going to kind of dive into today is what usually causes business partnerships to break up, right? Is it going to be the money? Is it trust? Is it expectations? Is it work ethic? And I think the answer to the questions is going to be all of the above. So what is one thing that owners could do that are partners to protect themselves in a partnership?
Yeah, I think there's a million things to do. A lot of times where I end up jumping in is actually when we're looking at it from the contentment of people having the resentment there and people being frustrated. A lot of times that shows up in the books, but I think beginning is when you actually structure that, the operating agreement, the partnership agreement, and kind of how things are going to happen, whether you guys are successful, unsuccessful, making the same decisions and not. And Danielle, I think you speak to that amazingly if you want to jump into what people should be doing at that beginning stage.
Yeah, and I think that sets the groundwork for any relationship, whether it's a two-person partnership or you have three or more people. At the beginning, you're getting along, you have your ideas of how things are going to go, and then it's just getting it formulated into whether it's an operating agreement or your bylaws, however you're planning on actually working together over the course of time. And because that goes to, as Brad, the main thing, like what happens, why did they break up? And it is a lot of times just not understanding where each are going. So at the beginning, having those documents in place helps with that framework. And so why they end up breaking up and why it gets messy is because there was nothing at the beginning. It was just, oh, we have this great idea. Let's see where it goes. And then they make a lot of money, and that money divides people, or they lose a lot of money, which also divides people. And then you're in this dispute, argument, and best friends become enemies.
I agreed. So, I mean, in some of the things that I mentioned, I think the biggest thing is expectations, because expectations of how or who or people, like all the other things, I think pour into expectations. And I think people jump in to business partnerships saying, hey, this is what's fair, or that is what's fair, or 50-50 is equal. When we've started to talk, I think we've touched in the last episode a little bit on that, but it's setting those expectations. So again, I think today, why are partnerships so hard? What makes a great partnership? Why do owners wait too long to address those issues? And I think the biggest thing and what they can do to protect themselves, and we'll talk about them all a little bit today, but your operating agreement, define roles and responsibilities, buy-sell provisions, decision-making authority, money authority, exit plans before problems start, are all things that if you take the time on the front end, we could be like, oh, we had this conversation before it became a problem, or found out it was a problem from the beginning.
Absolutely. But it's similar to getting married. Like nobody plans a breakup, but there's something you should be planning for at the beginning, because when it happens, it's messy and horrible to go through. But even from the protections of, in a partnership, people are contributing different things. So yeah, it's financial, it's emotional, and also, the work being put in is different. Some people are putting in a lot more money and equity into the company. Other people are putting a lot more sweat and hard work and operational decisions. And with those contributions not being equal to, especially as the money starts to go up and make more of it, or like we said, to losing more of it and taking on that financial debt, I think having those protections in place are important. So what do those protections look like? What can actually be put into the operating agreement or that partnership agreement?
I'll let Danielle jump on that one.
Yeah, and because it all depends on the relationship. So I think how you classified it, it is a marriage. You are And sometimes it's more time commitment than a marriage. If you are getting a business up and running, you're spending a lot of time there. So it's having those conversations at the beginning, and also having it with your family as well. But what you can put in your documents at the start, whatever we do with those, is asking the hard questions, because we can all put in there, oh yeah, let's each take 50-50 because we're both 50-50 putting into this, and you work out the easy thing. But then it's putting the hard things in there of what happens if we are 50-50 and there's a dispute. How are we going to get that resolved? Who is actually doing the legwork that's getting in the business every day, hiring the first employees, getting it going, and who might be doing the background work of bringing in funding or the things that you don't see every single day, like the IT infrastructure, and maybe you have somebody and you have different expertise in them, but it's getting that initial items in there. So whether that's through a job description or specific management documents.
And with that too, Brad, with buy-sell agreements too, I think a lot of people don't have an anticipation that their lives are going to shift and change, but people get sick, people can get cancer. You have to go away, take time, and you want to sell your shares of that. Do you get to sell to your partner? Do you sell to a third party that's going to pay you more? What are those things included in there? And it's similar to getting married. You don't want to sit and say, hey, when is this going to all end? Or when am I going to step away in a difference than you? But it is important because those things can cost so much money, but also the amount of time and stress, and then also your livelihood.
Well, and it goes to what Danielle was saying. It goes to what Danielle was saying about at the beginning of a marriage, it's hard to talk about should we have a prenup, should we not have a prenup, but it does more than just detail protect the person that had money or et cetera, et cetera. It's not just an emotional thing. It helps you separate things from creditors. It helps you protect one party against the other party. It also might provide for the party who doesn't have the money. The same thing can be true. Well, the same thing is true in an operating agreement. So we can talk about buy-sell agreements. What can you do to set yourself up from the get-go? You can choose the different valuation method in the operating agreement, right? You know, are we going off book value? That's probably not good for the person trying to leave. Is it a fair market value? That's probably better for someone, but maybe the company's jumped up in value, and someone, when they first came up with the operating agreement, they don't have a way to fund that. So one of the other things that happens here is in a buy-sell agreement, let's say, Aubree, I want to buy you out, right? In that same scenario, how am I going to do that? Do we have a mechanism to do that? So not just the valuation method. Are we using a valuation specialist? Do we have 3 or 4 valuators and we pick the one that's in the middle, right? Those are some of the things. People use life insurance policies to help people buy out. And oftentimes that's used when someone's sick or passes away. But what if I just want to buy you out because I want to move on with the business because I don't like what we're doing together. I don't like the direction we're taking. It's changed over those times. The operating agreement can set those up from the get-go and have those discussions, but they're almost always treated like boilerplate instead of real discussions. So Danielle, how do you have those conversations with people? How can they have those conversations with each other? Because everyone's happy-go-lucky in the beginning. We don't want to lose momentum. We will want to fight now, but maybe we should fight now.
Yeah, I like how we keep relating it back to the marriage and like a prenuptial agreement, because if you go into a marriage, you have one party, oh, well, we want to have kids, here's our projections, and then you have the other one that's like, oh, actually, I didn't. That's not going to work out, right? Or you have to make serious concessions. And if you really want to get it to work, then you get it to work. Same with the business in that relationship. Having those conversations at the beginning. And I do have hard conversations with clients where, have you thought about if one of you becomes seriously ill or disabled and you can't make decisions? What's going to happen? Are you going to have the other person step into that role? Do you have a succession plan in place if you want your kids to then take over? And is your partner okay with your kids stepping in? And so it's having those hard conversations at the beginning, so that way you are on the same page. And then you also have the hard conversation of, where do you want this business to go? Because I also see kind of what you were detailing, where you don't like where the business is going now. So one is wanting to buy the other out. So it's having that conversation at the beginning of, what is your 3-year plan? What is your 5-year plan? And where are you wanting it to go? Because then we can put that into the operating agreement now. And granted, it's not set in stone, so we can modify it as things change and the business grows, develops, people change and grow. And so you do that 2-year review. But at the beginning, when things are happy, let's make sure that we're on the same page and getting it into not just boilerplate. Hey, we pulled this off of Google and it said, oh, we have a shotgun provision. Nobody knows what that means until you ask those hard questions of, are you really willing to put up the money, have a 30-day out? If the company has the money, is there a clause in there for the company to redeem the shares? What all happens there? And so it is having those hard conversations at the beginning, which I think a lot of people gloss over because you don't want to think about the worst case. You're just wanting to think about, oh, this is going well. But we've all seen it go wrong too many times.
Well,
That
and that's the thing. You're 100% correct. That's the happy-go-lucky. We're all technicians in our field, and sometimes we lose the legalese or the jargon of our field. So right now we've talked a lot about LLC in a partnership. So we've used the term operating agreement a lot. So we're going to bring it down even a little bit further for you folks. We're talking about LLCs because I would say that's the most common mechanism, entity structure that people are using. Would you say that's correct, Danielle?
It is correct.
All right. And so I think one of the other things is the same can be true of a corporation. You know, we're using a different term. It might be a shareholder agreement or the bylaws or things that will spell that out. We use operating agreement because when it's two people, I would say the bulk of people we run across did or did not have an operating agreement and are running it through an LLC. And the other thing that Danielle's pointing out is each state will have certain things that are required to be in an operating agreement or it governs, right? And those same statutes allow you to modify a lot. So a lot of this can be negotiated, right? Am I correct in that, Danielle? And the various terms for a buy, sell, the valuation that I talked about, how certain finances are tracked, those types of things.
Correct. Yeah. So a lot of times, because we'll see in any of those agreements, it'll be, oh, we'll maintain capital accounts. And then we go to Aubree and she's like, so where's your, and nobody was doing it, but it's in the agreement because it's boilerplate. And then you have the disputes of, hey, I thought I was going to get my capital paid back. I thought, I put this in and I thought I was going to get this. And so then you have those disputes and Aubree is working through the books, trying to figure out who actually put in what and where it went because people are not business savvy and keeping things separate, which is what leads to the dispute and the breakup. And so even if you have within whatever agreement you have, your shareholder agreement operating, we'll just call it an agreement that you have at the beginning of your relationship. If you don't follow it, that's also what leads to the business dispute and then likely an eventual breakup.
Well, I had a question for Aubree with regards to that. So what are some of the financial problems that happen during a partner dispute? I think we could probably talk about some obvious ones leading to that dispute, but can we talk about some of the things you've seen when partners are in fact now in a dispute and arguing about money, who's trying to grab control? Can we talk about that a little bit?
Yeah, absolutely. So once they're actually in that dispute and we're talking about a buyout or are we dissolving the company, what does that look like? People don't understand that how you've been filing, recording all this stuff, but also filing your taxes, your basis is set. Well, you're able to have flow through to you on both a loss and a win basis. Those things are all established and not easy to go back and change years later. So when you're talking about the actual buyout too, are we having the entity purchase out the partner or are we having you personally pay out that person? So the tax implications there are hugely different too. Also how you're set up though is going to determine what we're able to do unless we're going to go back and amend tax returns. A lot of the big things though that I see is a lot of people do create a partnership, let's just even call it 50-50. They are using the operating company basically as where everything is flowing in and out. So all of the deductions they've been taking more personally, as well as everything through the business is all accessible through those one LLC or partnership company.
Let me slow you down there. So are you saying some of the discretionary things that a different owner may not take, that they're maybe being a little more aggressive on their deductions, that Aubree's taking these 4 or 5 deductions. Brad's taking these 4 or 5 deductions, where Danielle, if she was a buyer or a different owner of this business, may not be taking those deductions. Is that what you're talking about? That you can
Kind of.
write them off, but
Yes or no, but more so even just between the partnerships. So, as people start, like say there is not those hard set rules and you have it just all flowing through the operating company, you and I might be putting through as much as we want when things are going well. So we're like, hey, we want to get this bottom line as low as possible. But as things start to dispute and we are having differences there, or things have changed, I have more expenses here, I've added more people to my phone plan, whatever those little things could even be. A lot of people, before those hard conversations start coming up of I do want to buy you out, I do want to sell, the cash flow starts becoming a little bit more restricted. And a lot of times that is because we've always been allowed, hey, we're going to put as much as we can through the business. We're going to do these things. But those start to seem very unfair as we're starting to look at how are we going to do a buyout. So a lot of people I have seen believe that either the partner is being irresponsible with the finances or intentionally trying to whittle things away prior to getting into those conversations of how do we sell. That's a big one. So I recommend from the beginning, for tax purposes, honestly, too, but always having a holding company on top of the operating company. You can do your separate deductions and everything out of there. But for a valuation standpoint, or if you're having to sell or any of those things, you can look at specifically what the operating company is doing and what it's bringing in before actually going into your holding companies. But that does protect also what you're allowed to do from a deduction standpoint. But it does make it easier.
I actually think that's a really, really interesting tip for owners, right? I think if I am, if the 3 of us have a business together and we're all paying ourselves a salary and we're reimbursing each other for expenses, what I think I just heard you say is like, hey, we have the operating entity, but then I have a holding entity. So yes, I can, to keep the operating entity's books clean, I pay this company 150. We have a company that's doing that great. All 3 of us, we have 150, 150, 150. But in our holding companies or management entity, we're more aggressive with our deductions. So it's easier to look at the operating company, value it separately. We can agree or disagree how much, but each person's getting 150. Is that what I'm hearing you say?
Yes,
Like
exactly.
having an entity structure.
So in that sense, like we talk about the deductions all the time. We all have kids. We have different amounts of kids, each of us, and I make my child an employee. That means I got to be discretionary of how much I want to pay her through my holding company or management company. But also when it comes time, if we have a dispute and you guys want me to be kicked out of the group, basically, we're still protecting what the actual operating company was bringing in without any of those add backs or how we're going to add in your EBITDA, because they're very discretionary. You would be able to speak on this even more than me, but the buyer does have a choice, or like what they're allowing to be discretionary or what they do think is business too in some factors of
I
that.
think that's a big tip. Do you think it's a huge expense to have a 2-entity structure, even if it was 3? Like if all 3 of us owned a business, operating business together, and we all had our own management or holding company, that's not a huge expense, correct?
So,
in terms of compliance or whatever to help prevent disputes.
Absolutely, not at all. So to create the entity, it's free to get an EIN number, but just a simple LLC, even expedite, I think it's $85 for Arizona. Again, varying state to state, but we're usually looking under $150. You should work and put even an operating agreement in place for that too, because again, if you die, if something happens to you individually, what happens to that company? But then outside of that, you're just looking at a Schedule C. So basically just one more form on your tax return each year. You're not having to create a new tax return or have different compliance things. It's very, very minimal in the sense of cost, but you will save so much long term, even just from a tax perspective, even if the partnership goes great forever.
Danielle, I'm interested in your thoughts on that, on kind of the legal compliance piece of that. Right?
It is. And I think this is definitely a topic that we could have a whole podcast episode on, because there's a lot of definitely tax benefits, but then it's getting it set up correctly, because people will be like, oh, I'll do the S Corp election, or I'll do the C Corp election, or I'll have sister LLCs or series LLCs, and they're just not doing it correctly. So granted, is it affordable? Can you do it? Yes, but it's making sure that you're working with the right people to make sure it actually is structured correctly. So if you do get an audit, it's not going to cause an issue.
I think that's a good point because it seems like at the operating level, try to avoid any audits or gray area. And if you want to be more gray or be more aggressive or anything like that, or things that are more discretionary, you could do it at your management or holding company level for partners. So again, I think that's a pretty interesting tip. I would say from a valuation standpoint, right? If we do have some sort of fair market valuation in a dispute, and that's the valuation methodology that's going to be used. And again, folks that aren't listening, there's lots of valuation methodologies you could use to value your business. So I'll just talk about one that most people would think is fair for your business. Is the only add back or the only change in something like that would be, in my hypothetical, is Aubree's making 150, I'm making 150, and Danielle's making 150. Is the only add back that you're really having to consider there from the operating business's perspective is, was 150 too much or too little in terms of an add back for lending in the buyer? If 150 is 50K more, then it's an adjustment that is actually better and creates more value for the company. If it's less, then if this business, we all should have been making 200K for our respective positions and work we're providing, it does impact the value later. But that same structure that Aubree brought up that I find very interesting is instead of looking at all the granular things of the operating business, when that's the thing that's generating the money, that's the thing people will be interested in later.
Absolutely. Well, and in a pass-through entity, so in a partnership, even just LLC, but let's call it an S corp, anything that is multi-member, the profits are flowing through to your personal return. So from a tax perspective, whether you take the money out of the entity or not, or you just leave it all in to continue reinvesting, it is going to flow through and you're going to have that tax implication on your personal return. So in a scenario where you have already bad blood, things are going on in there, and an owner who is operating, running everything, and maybe someone has a 20% ownership of it, person operating it is not taking any distributions, not bringing out any of the money, keeping that very high then net income. What happens is, even if the other person, the phantom, basically 20% owner, has all of that money coming through to them on their tax return, whether they saw a dollar of it or not. So that's another big thing I've seen, is people being very shocked by that K1 at the end of the year because no distributions were being taken initially by the operating person in the business or the partner. So Danielle, and maybe you can speak on this too, because that is something I see quite a bit of, but there are protections that my understanding can be put into those bylaws or operating agreement, even just surrounding that.
It is. And that's one of those negotiation points. So you can have in there who your financial person is, and it doesn't have to be one of the members of the company or a manager or one of the shareholders. You can have an outside designated individual that you draft into that agreement that can work on, if you are doing quarterly distributions, are you following the company, and what threshold. So you can also set within those agreements what threshold you want the company to have at whether it's return on revenue, your profits, however it is, you have a threshold before distributions can occur. So you are having so much go back into the company. So all of those should get put into those initial documents and then reviewed every 2 or 3 years. So that way you are keeping the partners on the same path going forward to hopefully avoid a major breakup, and maybe they do want to go separate ways, and then we're having a nice conversation versus we're fighting and it's getting gross and nasty and people aren't working together.
And what about with that too? Because the other one I see kind of wrapped up in there is the personal guarantees. A lot of people don't realize that they're really a personal guarantee on, because it's in their business name, whatever, but their personal credit a lot of times is being hit. And in the sense of a partnership, even after you've done that buyout or that guarantee you think is gone because it's in the business name, a lot of times you still are personally liable for whatever that debt is or the note you have. Can you explain or walk us through kind of a little bit about what you could do to protect yourself there, or how to remove that if you are doing a buyout or sell or dissolving your portion at some point?
I think that's a great point, a great follow-up. So let's say we're get to a dispute and we're trying to get out of it. Maybe what we might do on the front side, and then what do we do if now I am getting bought out? What do I need to do to protect myself? Was I on any credit letters or vendor things? What else should I not be on anymore? So I think that's a great question.
Yeah, and that can get really complicated because now you're pulling in outside parties that have nothing to do with your business other than they gave you money or they gave you a space to lease. So a lot of times landlords will require a personal guarantee, especially on new businesses, that because they're putting a risk there. The business is either going to fail or succeed. And so they'll have the owners do a personal guarantee. So not just with financials, with banks or credit cards. And you may have the ultimate breakup and people are going their separate ways. But if that third party isn't going to let you out of that personal guarantee, you have to seek indemnification from that other partner. So you're going to have still maybe an ongoing relationship if that third party doesn't let you out. So you can draft the documents
That's
as
a great
best.
point. That's a great point. We're already in a dispute, or people are already in a dispute. They're trying to get out of it. They've agreed. They're emotionally drained. Their money is drained. They're ready to be separated. But now we have third parties saying, "No, just kidding. If you're going to keep operating this, we have a problem here." And just use real estate as an example here. So one partner is going to continue to operate. We've agreed to do this, and they're like, "Hey, landlord, I'm selling to my partner. Would you let me off of this guarantee? Because just because you agreed between the two of you doesn't mean you're off." Is the point that we're trying to make here, folks. And so the landlord could say yes, the landlord could say no. You can negotiate around that. Maybe the partner leaving or the business pays a buyout for the partner leaving, but now that's another term that, oh, we just came to an agreement. Oh, just kidding. We still need to negotiate with the third party. So I think in any partner dispute, the partner should list some of those third party folks that, oh my goodness, my personal credit's on the line for this. And those personal guarantees need to be either terminated or something like that. Signing really doesn't do anything. You're still on the hook if you assign something. So you need to make sure that those guarantees are terminated when you leave. And if not, as Danielle pointed out, is the partner that's staying in the business, or the business will indemnify the partner that's leaving. And what that means is that they will pay those expenses if they breach those terms later. But that's also scary because now the partner leaving has no control over their finances, no control what direction the business is making. Maybe they get a lump sum, maybe they walk away scot-free, maybe they take some of the intellectual property, but they don't control what's happening that could cause that sort of breach. So it's just something to be aware of.
That leads to making sure at the beginning of the relationship, um, when you want it to go smooth and you want everything to go through, but having those hard conversations of, hey, if we do break up and I'm a personal guarantee on here, so what can we ensure that will protect me if we go our separate ways? And so having those conversations at the beginning, and nobody wants to be like, oh, I think we're going to be well together and we're going to drive off into the sunset and sell the business for millions and millions of dollars and we'll be happy. Not how most of the time it works. Usually it's people just part ways at certain times or somebody dies, but it's having those conversations at the beginning. And those are terms, not, you don't have to draft like the full specific terms or have like the conversation where you're having the whole other agreement put in place, but you can have the initial framework of what you want to happen if there's a personal guarantee attached to it. And the person staying can say, yep, I'll agree to certain things, and then you just have the initial groundwork there as opposed to the full agreement, but having that conversation at the beginning for sure.
But I mean, we talked a lot about the operating agreement, bylaw, shareholder agreements, those types of things, and we can outline those. And there's a lot you can outline. My question is, what if we don't have an operating agreement? And by the way, none of our listeners should act without an operating agreement or shareholder agreement or bylaws. But what happens in just a normal partnership scenario if there is no operating agreement? Where do we look for that kind of dispute?
Yeah, so all of the states are going to have certain laws that are already put into place. So similar to any other. So if you have a trust, a will, all of those things, that dictates what happens if you pass away. Same with the business. So if you don't have anything in place, there are certain statutes, provisions that will dictate what happens. Unfortunately, a lot of them are just very open. So
Yeah.
you're going to likely end up either having to come to an agreement at the end of the process where, hey, we need to depart ways and now we need to have an agreement on what's going to happen, or you're left with going to court. And a lot of times, if the business is still up and operational and there's money coming in and going, they're going to appoint a receiver. And now you have an outside third party coming in, running your business, which gets extremely expensive. And you have no control now if there's a receiver put into place. So, worst case scenario is you lose your business because you didn't want to have the hard conversations at the beginning.
We can talk about control. We can talk about 50-50, 75-30 control versus decision making. Do the state statutes also deal with some of them, like the standard money splits and profitability splits and allocations and stuff? But you
Kind
can
of.
also change those, correct?
They do, yes. But that is, again, we'll go towards the operating agreement first, but it's really just going to be on what percentage you own. So a lot of people think they're 50-50 and they're equal partners, but there's really, I've never seen an equal partnership. I mean, whether it is husband and wife or partners, like everyone brings something different to the table, things shift and roll and change. So equality is not equity, but in the sense of what the state statute is going to say, yes, it's just going to be off your percentage ship, which we don't want that to be for the 90% of the situations, and that I say at least as far as partnerships go. Because again, what you're putting in liquidity wise or having as far as cash into the business and also what you're growing changes throughout time. But a lot of people start at, $100,000 as a business and that goes to $4 million. Those profits really are just going to stay at what your ownership percentage is if you don't have something determined already. That said, though, how often, Danielle, do you recommend someone change their operating agreement? So from the standpoint of if you're at 100,000 to 4 million, is it based on typically a value amount where you're at each year or from revenue or profit, or is it more so based on the direction of things changing personally in people's lives? Or what do you see on that standpoint? And then how often to actually refresh that?
So I always recommend a review of the operating agreement every 2 to 3 years. So
Okay.
at least reviewing it, making sure that it's on par with what you're still doing. And then if there are big changes coming, then you do need to review it and see, okay, where are we going? What are we doing? So big changes are usually seen when you are getting ready to hire an employee. So a lot of times it's just you're doing great. You might have outside contractors coming in, but when you're getting ready to hire an employee, because that's going to drastically change the landscape of how your business is going. So a lot of times it'll be two people, they're doing great, and they're like, oh, now we're at the point where we can hire someone. Definitely review the operating agreement. Also, if you are planning to bring on investors, third parties, or as Brad will say, like if you're getting ready to sell within the next probably 1 to 2 years, we need to review the operating agreement and make sure we have provisions in there. So that way, if you do get a bona fide offer and how that's going to play, who's going to determine all of those mechanics that you might not have at the beginning because you might have thought, oh, we're going to go off into the sunset. Our kids are going to take over. Turns out the kids grew up. The kids don't want to be involved in the business. So now we want to sell it. And so at least every 2 to 3 years. And then when there's kind of major changes going on in the business.
Okay, perfect. And so who do you lean on to then typically help them actually put down what those percentages should be and what capital should go where in those decisions? Is that typically when you get the team together to go through that? Or how do you advise the clients for that?
If their interests are changing, that's a whole other dynamic. So that's determining if you have shares or units available for distribution. So you will already have in the operating agreement a certain amount that's allocated, and some of them may not be issued, but they're available. And so you'll already have dilution mechanics built in. If there's not, and somebody is like, hey, I'm putting $10,000 more in, but because I'm doing this, I need to get more from it. The agreement should already have those mechanics built in. So if there is a capital call, somebody doesn't need it, then there's an automatic shift. But if you don't have that built in, and then somebody's just putting that money in, there's not an automatic change in percentage ownership without items already built in there, which is where you get in the dispute of, hey, I put in 100,000 in, you didn't do anything. Well,
You'd be surprised how many people don't understand that, though. They do believe they're putting more in and they're doing these things that is going to update those percentages. And it, like you said, it doesn't at all, even from like an annual tax perspective, unless you're putting it in as a like owner payback or contribution. But I think that's important too, as people are starting to have those shifts and changes, or even just operationally, that they should be looking at it as well from that perspective.
I heard Danielle use a couple terms too, dilution mechanics. There's a couple different things. Could you talk about that a little bit? And then what a capital call is? Because I think that's pretty common where people are doing some sort of fundraising, or even if a few family members or everyone's putting in 25K or something like that. Can you talk about dilution, what that means, and then a little bit about what a capital call is and what that might look like? And maybe what a more standard way of doing that is for a small business.
Yeah. So since we are talking about more than one person involved, so if it's
Yeah.
just you and yourself in your business, you don't have to worry about a capital call. But when it's more than one person and the business just doesn't have enough funds to operate, so whether they need to make payroll, or maybe they're looking at doing an acquisition or something where they need funds. So you'll do a capital call, and the operating agreement or bylaws will say if you can do that or not and how those mechanics will need to work. But that's essentially asking all of the owners of the company to put in their percentage interest. So if you have one partner that's 80% and then you have four that all amount to the other 20%, it'll be percentage. So the person who has 80% in will have to put in more, and then those other four would have to put in their part of it.
And what if
And
they
then,
don't? What if they don't, Danielle?
oh,
I think
that's what I was about to say.
that goes to the dilution piece, right?
Kind of. It depends on what the agreement says. And
Okay.
so you can have, so if the person who has the 80%, they have the funds to cover the other four, and they say, oh, I'll put in 100%. That doesn't mean those four are now 0%. So it can be decided, okay, well, I'll loan you the amount and then I get paid back that loan first. So nobody changes. Or maybe it says, well, if I put in that percentage because it amounts to this much, my increase goes to 82%, and then you guys all drop by 0.5% or something along those lines. So that's the dilution. So those get diluted while one person goes up. Or you are doing a raise, and so you're bringing in a third party investor, and now you have 6 people in the business. And so that 6 person, if you're already at 100, the 6 person can't come in and put it at 110%. So you're going to have to reduce the 80 and reduce the other 4, so that way you're still left at 100%. And this is where decimals become a pain in the butt, because you might be at 0.99999, and so you're trying to do the math to make sure where it is. But that's the dilution. So you might not always stay at 80% if you bring in another person, or your other 4 might go up if 80% can't fund it. So that's what dilution essentially means.
And that may or may not, depending on how the particular agreement is structured, change decision making, change profit distributions, to change allocations, those types of things. Because sometimes it does matter. Sometimes it matters for control, because people often think, oh, we're 50-50, but that might be profit only. That might not be in decision making. So it's just something to consider, right? Like there's two parts. There's decision making, and then there's the money piece, right?
Correct. And you can have a capital call, and you can say if you didn't meet the capital call, you're losing your right to vote. So you may share in equity and the profit and losses, but you don't get to have decisions.
So there's a lot of ways to still structure that, right? Like if you can't bring money to the table. So this is another thing to talk about on the front end. Maybe someone is almost a full sweat equity person in the other person's money. Maybe that as they're setting up that operating agreement, they need to say, hey, there are no more capital calls. If they do, they need to borrow money or raise it in some other way with no dilution, because the sweat equity person may not have any more money to put in when it's necessary, right?
Right. And that's usually how most of the partnerships are, right? So you have the one person who is like, this is the idea. I know I can grow it. I can get it there, but they don't have the money. And so they find the money person, and the money person is putting it all in, but not doing anything. But now the business is generating enough where the investor is not doing anything. but they're getting half of it. And you're like, well, I put in so much and now I'm not getting 100%, but they already got paid back their investment and now they're getting more and more and more. And that's usually when we'll see the relationship crumble because one person feels like they've done so much. And then you have the other person that's sitting in the beach in Hawaii that's like, well, you just keep doing what you're doing and I'll keep, filling my bank account. And neither is wrong. Like they wouldn't have been able to get there without the funds. And the investor wouldn't be able to be sitting on the beach in Hawaii without that person putting in all of that legwork. So what do you do there? Like who is right and who is wrong? Neither really until you have an agreement in place on what happens there. And that goes to kind of probably Aubree's statement of, hey, if things do change, can the percentage interests change? So maybe the investor hasn't put in any more money and the sweat equity person's been doing a lot. Over time, can that interest decrease while the other person's increases? You can certainly have that built in, but you have to have that conversation at the beginning.
Yeah, I was going to say that exactly because I'm actually working with a handful of clients right now, and two of them are having that issue where if you don't have that up at the front, why would the investor want to have to not be collecting their money while they're in Hawaii, even after those have shifted hugely? So definitely important to try and put in place at the beginning, but things people don't think about. There's not necessarily a manual, and it is all very proprietary to your situation. So working with an attorney, having that done is so important, but it also guides how all of that is going to flow from a legal and tax standpoint moving forward too. I think that was great, Danielle.
Well, I kind of wanted to move on. Like, I think we really hit some really good points on disputes and things to be aware of. But, I think there's a few questions that I'd like maybe all of us to kind of quick fire at. And I don't know who should get the easy one, the first question. But I think we've heard it. What's the biggest partnership mistake? And I'll let anyone go. Who's going first? What's the biggest partnership mistake?
Not having an operating agreement or the hard conversations first.
No, I love that. And so, Danielle, what's the biggest myth about partnerships?
Biggest myth about partnership.
Yeah, the biggest myth when I'm just entering in a partnership with someone, just run a business.
I think it's just the thought of, hey, we're friends, we're going to work this out over time. So let's just napkin out what we're planning to do, and then it's going to work out. It doesn't.
No,
right?
I actually think that was a great answer. I asked you the hard one, Danielle. So you're totally right, because everyone's like, no, I have this relationship with this person. But there's so many more dynamics, I think, as we all know, that are influencing each owner's like position in the business or role in the business, on top of them just being in the business or being involved in some capacity. So it doesn't always work out. Money, family, third parties have opinions about it, and they're all influenced by all of those things. So,
you said, like partnerships, it's not just two friends. It could be husband and wife. It could be daughter and father. Like partnerships have so many dynamics. And if you don't want your family to have a dispute at Christmas time because of the business that your family is running, it's also making sure that you have that dynamic. So I think when we're talking about partnerships, it's also remembering it's not just two friends or two colleagues that are working together. It could be your actual family where you are now sitting at the dinner table talking about business. You're working all day talking about business. Now you're having Christmas talking about business. And you might need to have that conversation at the beginning of, hey, business is business, and then let's also have family time.
Yeah, I think that's really important. You kind of brought up a good point, and you might be able to shed a little bit of light here. Even if it is two people, you are looking at more than just those two people. Say it's us three. I get a divorce. My husband wants to come after some of my interests in the company. I don't have enough to pay him out personally, and part of that divorce. What can you do to protect from even those external parties that are going to be part of the partnership too, in a sense?
Ooh, that's a really good question.
That is a really good question. And that one I know, because we have a lot of that's definitely a long answer that I'm also sure Brad will also have input on as well, because that dictates a lot of decision making, and sometimes the whole business has to be sold because of that. So let's table that one and come back to that one. But that's
But just real quickly, it goes back to the number one question, Aubree, that you answered. Yeah, the where they go wrong, it's the operating agreement. You have to consider spouses in there. There's waivers. There's things like that where a spouse has to sign off. This is my spouse's sole and separate property, or it is community property, but I'm electing my spouse to make all the decisions for this company because he's the one who's involved in, or she's the one who's involved in it. There's a variety of those types of things that, again, people may not be able to move forward. They might have to sell the company because, again, in Arizona, at least, it's starting off as a community property deal,
Yep.
right? But you need spouses sign off. They need to be involved in the decision making. They need to be in the know. So it's a really big thing. And it goes to the third party dispute thing. You're like, hey, if all three of us are in a business, our spouses are involved in that too. And it's a very important consideration.
Yeah, absolutely.
So I'm going to give myself an easier. I don't know if it's easier question. Like, what do owners wait too long to fix? And I think it's not talking about the expectations, because I might have just said, hey, why don't we just split this a third, and a third? And then people start doing things and they're uncomfortable with it very early and often, and nothing's really created value yet. So I think even if you've started something, even if you started selling, even if you started providing a service, it's then having that conversation. I'm like, hey, we need the operating agreement. We didn't set expectations well. This is not what I thought it was, because you don't want to be down the road too much further, and maybe the finance person is a lot more significantly at risk than the finance piece. The other person is like, I don't like that you're putting all these things on me. I think it's letting those get too far down the road before we can have a split where there's something serious. So, we're all talking about the examples where, oh man, we grew something into something significant, and then things are changing, or the business had hard times and now there's disputes. But early and often, resetting expectations very quickly, because in my experience, most people are like 50-50 or 80-20, or I'll bring the money, you bring the whatever. But they didn't talk about control. They didn't talk about decision making. They didn't talk about how that 80-20 is actually split. Is that money or decision making? So it's recalibrating that very quickly.
Absolutely. And to add to that too, I think that a lot of times, whether one partner doesn't know or multiple don't know, the financial layout of what they're recording year after year is going to dictate so much of that too. So making sure that they actually have an idea of what that is that done correctly, but also making sure, hey, are we paying ourselves a reasonable salary? Are we taking these distributions? Are they fair? Are they uneven? Because a lot of times you're running through business and you're crazy, it's busy, things are on fire, and you're not looking at that. And that is truly going to dictate a lot of these decisions, even if you have all the agreements in place at the beginning.
And I would add to that as well, Brad. I think it's talking to a third party to have those hard conversations. Because what I find is a lot of times the partners will be having the conversation and then they gloss over it. They don't want to get into the details, but then it's going to that third party that can get into those details and say, you didn't answer the question. So let's go back to it and make sure we're actually answering the question
100%.
so we can get it documented correctly. Because it's
I
where
can be a politician in my business ownership. I can
Yes.
keep dodging the question. That third party forces you to answer it so they can do their jobs, right?
And so, I would say that's kind of what gets delayed is they don't seek the third party help. So many times business owners, whether you're in a partnership or you're by yourself, we all have problems delegating, right? We all have that control issue. And so now you have two partners who have control issues. And so it's being able to say, I need to talk to a third party, and it's not expensive at the beginning, right? So the whole question of, oh, we can't afford it is just BS, because you can. And you just need to have that conversation with a third party, whether it's an attorney, your bookkeeper, your CPA, a financial person, because they're going to ask those hard questions in those areas to make sure that you're on the right path going forward. So I would say that's somebody that you should bring on early on in the relationship, and maybe even before that relationship gets started.
I agree. And I think a lot of people like to default to that is the money's not there, or we're just starting out, it's too expensive. But Brad, you can correct me on this if I'm wrong, but a contested evaluation is typically even just a loan between $10,000 and $40,000 just for that piece alone. And that's not even talking about what you're going to lose monetarily or emotionally outside of that. So it's when you look at the cost of actually hiring someone and doing it from the beginning, it's not too much money at all. Like the money is there because the money will be gone either way at the end.
I agree wholeheartedly, right? It could be as complex or not as complex as you need. If you're raising a bunch of money, if I'm going to go and ask someone for, I don't even want to say a bunch of money. If I'm going to go ask someone for $50,000, you're telling me I can't use $2,500 of that. And I think that's a conservative estimate to get some of this stuff drafted well, right? And you can go cheaper than that and still have a lot of the provisions and things that we're talking about. So I think it's important that in a scenario like that, where I see it is like people are trying to bootstrap with $1,000. Sweet. All right, if we're going to bootstrap with $1,000, maybe our first sale needs to include the attorney, that early. And that's what I'm saying. It early and often, maybe people can't always, maybe that's not practically accurate to do it all or practically possible right at the beginning. But after your first sale, those types of things, like you sold a service, literally save money, set the budget to have someone set it up early and often and have those conversations, because then you're not out and about on a lot of things. So I guess before we take off, and I kind of want to hear from everyone on this, is what is one thing from your perspective that an owner can do, and we're not going to do operating agreement, to protect themselves? Maybe it's something to include in the operating agreement, but from each of our perspectives, what's one thing an owner can do this week to protect themselves in a partnership? And
I can jump in first. So mine would be to go ahead and pull your last 3 years of reports. So a P&L and a balance sheet, but also be pulling out what the distributions were for each of you in the partnership, as well as what you guys have paid yourself in salary. If you don't know what those are, they're not clear, you absolutely need to be working with someone immediately. But those 3 years are going to tell you kind of what the story's been. And then if you have a plan for where you're going moving forward, if those are in line, you'll be able to tell if you're on the right track or not. But realistically, most of the time, people don't look at a 3-year comparison for their businesses, which I think you should be doing. But from there, you can do all your planning around it too. So even if the partnership's great, you have your operating agreement, you can actually get into the nitty gritty. Do we have a holding company? Do we need to add management into this? What else can we be doing to help us? But typically, when you look at those 3 years running, you realize things aren't necessarily flowing the way you thought, typically.
how about you, Danielle? What's one thing someone could do this week to better protect their partnership?
So I would say to ensure you actually have an entity formed. So not just, oh, we're together, we're in business, but going through and making sure your entity is actually set up and in good standing. So go to the website of whatever state you're in and making sure that, the business is there and it is in good standing.
And then I think for me, the protection piece on exits, and from my perspective, is the valuation piece. The mechanics are if I want to leave. So it's something that needs to go in the operating agreement. It's the piece that says, I don't want to be with this partner anymore. What is that buyout process? Let's talk about the type of valuation necessary. Are we hiring a third party? Is it book value? Is it fair market value? Is it something totally different? And I think having a buyout provision that has good mechanics that people can agree to up front is something to look at. Hey, like, do we have a buy sell? Do we have a buyout provision? Does it apply to death and incapacity, or does it involve disputes? So I'd look at this week, and if you have an operating agreement, see if that provision is in there or something like that, and say, hey, we should talk about that. So, well, hey, ladies, thank you so much for this episode. We will do a little teaser for the next episode. We're going to be talking about cash flow and the cash flow lies, why profitable businesses still run out of money. So again, ladies, thank you so much. This was great.
This is awesome.
Yeah,
Make
thank you,
sure to
Brad.
subscribe.